Welcome back to Real Estate Without Borders. Today, we are going to talk about the 4 most important metrics that you need to know to analyze investments around the world. My name is Daniel Foch. I'm joined here by the one and only Dave Hutch. How's it going, man?
Good, man. It's great. Red, tanned, warm,
Yeah,
living in Mexico.
full lobster mode.
I did move around some lighting, so I think we're getting closer to where we need to be here.
The red's good with the blue light. It's like what do they call that? Primary colors or whatever, complementary colors. You remember that from like grade 3 art class? I do.
Well, I was not. I wasn't a big art guy, so I
No,
don't. I was
yeah,
curling on
yeah, outsource
curling at
that.
recess,
Yeah,
just dominating phys ed, and that's it.
yeah. Makes
That's about
sense.
it. I think you made this episode for you. I'm going to be here. I'm a big personality hire on this one. We do use these metrics a lot, to be honest, but
Yeah.
some of these are great. They're great.
Well, yeah. So there's 4 key metrics that I think you really want to analyze when you're buying property. So typically, when you're buying a piece of real estate, you want to get an understanding for the yield, right? So your cap rate or whatever, price relative to income. Then you want to get an understanding for the loan, the interest rate that you're going to be paying, and where does that fall relative to said cap rate, because that kind of determines the spread, right? Let's call it like your rolling profit, almost like the difference
Right.
between if the cap rate's higher than the mortgage rate that you're buying the property with. Typically, you can make that investment viable. And then we also want to another kind of variable gets thrown into the mix here. This, because we're buying outside of our own countries, is the currency exchange, right? And
I
so,
love this part of it. This is cool
yeah,
because this is something that I've only really dove into this year. So it's super cool.
yeah, and so I mean, you really want to think about like this is probably what makes most investments compelling present day for people who are holding USD, right? USD is so strong relative to currencies around the world right now. I'll pull up the chart that I've shown a couple of times on the show, but like USD is currently trading at like record highs against a lot of currencies. And so people who are buying real estate in other countries with USD are getting a relative discount today. And assuming those currencies recover, which I mean, in the fullness of time, I don't have any reasonable reason to believe they won't. You'll also get a benefit from the growth of that domestic currency, right? So we've got our cap rate, right? We've got our mortgage rate. We've got our vacancy rate, which is going to kind of get factored into our cap rate. And then we've got our exchange rate. Those are the 4 key metrics that we're going to go over today. So get me started on the exchange rate, Dave, because you just said that what did you say? You just got into it and now you're a full-time
Well, it's
Forex trader?
now I'm a for we should don't say that. I got a few TikTok accounts out there that are doing forex scams, and I got honestly, I've had 3 people in the last week be like,
How
"Oh,
much money did you lose on
yeah."
Forex scams? Let's go.
I was gonna just put my email in there so they send me the money myself. But I got these 4 TikTok accounts that just go over people with crypto and forex stuff, and I don't know how they make these accounts look so good, but that's not important. But the currency exchange rates, I want to give you an example of a deal that we just structured here in Mexico. It was an American buyer, and when I moved here to Mexico in early 2024, it was actually end of 2023, but whatever, who's counting? The exchange rate from Mexican peso to dollar was about $1 was 16.67 Mexican pesos. Okay, today it's around $1 per 20.67 Mexican pesos. Okay, so let's cover a deal. So a lot of the developers down here are selling properties in peso, which is a massive advantage to Americans. Now, this was a real deal. So the property cost was around 6 million pesos, which I'm pretty confident. So, okay, let's do it like this. Actually, I'll make it easier. Okay, let's do a deal, the same deal that would have been structured in February of 2024 versus today, February 2025. So February 2024, $1, 16.67 Mexican pesos. Property cost was 6 million Mexican pesos. That would work out to about 359,000 US dollars. Okay. Now, fast forward to today, the exchange rate is $1 to 20.67 Mexican pesos. That same property, 6 million pesos, would probably run you around $290,000. So that's what a $69,000 difference buying 1 year ago versus today, which is pretty crazy, honestly. That's a huge win. That's a big discount, $70,000. But I mean, at the same time, this show is unique because we're helping Americans invest globally. And there's a lot of factors when you're investing globally. And when we're talking about exchange rates and the exchange rate fluctuations, that can really make or break your investment. So if the US dollar strengthens, US investors get more purchasing power. If the US dollar weakens, obviously the foreign property values in USD would increase. And that's just a Mexican example. But maybe you can kind of give your little input on what you're.
Well, I would say it's it's the same thing. Like in Canada, had you bought this time
Right.
last year, 2 years ago, if you bought 2 years ago when prices were high and exchange rates were high, you get double smoked, right? But on the flip side, now prices are low and exchange rates, or the Canadian dollar is low relative to the USD. So Canadian dollar is like 69 cents. It'll probably go down to 65, to be honest. I mean, Trump doesn't seem like he's finished with this trade war stuff. I think Trudeau's now calling a summit for all of the local or the provincial leaders to get gathered on this to discuss it. So I think it's not over. I think Canadian dollar will continue to be devalued against the USD. Probably the peso will continue to get devalued against the USD. And so over the next 2 years, I would say probably potentially over the entire Trump presidency with his America First agenda, you're going to see relative discounts for any property that you can buy in a local currency in any country on earth,
Right.
quite frankly. And so we talked in the UBS bubble index about Germany being down 20%, and the euro is down, 20% off peak relative to the USD. So you just
Right.
you get a double whammy. You get to stack that discount. And now all of a sudden, if the euro recovers, even if it recovers 10%, you get 10% gain from the currency, plus you get, 10% gain from the actual nominal increase in price. It just feels like a no-brainer to me for people who are holding USD. It doesn't even have to be Americans because it's the most held currency globally, right? It's the most in circulation currency globally. If you're a Chinese investor holding USD, right? If you're a German investor holding USD, because so many of them are, right? So many people have been piling into USD, and now they're like, okay, well, USD gave me a great return over the last couple of years. Probably can't squeeze that much more of a return out of holding it relative to the investment. Now, where can I go and deploy this USD and really get that big benefit? And that's where we're going to start seeing people put currency to work by buying in other countries. And I think, there's so many wealthy people around the world that have been I think your real smart money hasn't been piling into this speculative fever of buying real estate over the last couple of years. I think now that values are coming down, you're going to start to see the institutional buyer really hop back into the market in a meaningful way.
I think this is why we made this show. I think for the most part, this is like the actual reason why we made this show, is to help anyone holding USD or American investors understand the different key metrics on how to analyze a deal, how to structure a deal, and what to look for in terms of a good and bad investment. But it's like, this is something that I honestly feel like most people would likely overlook this aspect. It seems simple, but I feel like this is extremely overlooked. It's like you said, it's a double whammy. You're earning not only on the equity of the property in that country, but also on the currency as well.
100%. I think that it's like, I don't think that it's reasonable to expect the outcome of everything that's happening in the global economy right now for, countries like Germany and, China or whatever to be in recession forever, right? They're just in recession earlier than US. And so if the US stays strong for 2025 and Germany slips into recession, China's already in recession, seeing deflation. I mean, if you can buy Chinese real estate that's down 60% with a currency that's down 30%, and then it recovers, let's just say eventually it tracks back to both of those. Eventually it recovers that 60%, plus it recovers the 30% that it lost on the currency. It's a way easier trade to make than buying your US real estate that is probably overvalued relative to income and rents right now, right? Rent's never been a better discount to home ownership in the US. Literally never. Like, it's never cost, there's never been a bigger spread between monthly mortgage payment and rents in the US. And what if US home prices gone up by on average like 4 to 5% year over year for the past? It's like, okay, cool, yeah, you can buy that, that's fine, I'm totally cool with it, slow and steady compounding, I get it. Or you can buy these depressed markets, go and find those competitive advantages in the markets where nobody's lining up to buy, their domestic owners aren't lining up to buy, and you get a huge advantage as a foreign investor. So what does this mean, Dave? Tell me you got some good notes here for what this means.
Well, okay, let's cover. So some real estate markets obviously move together with their currency, while others are moving in like opposite directions, right? So if a country's currency is strong, usually the real estate is more expensive. Look at the US, right? prime example. If the currency is weak, maybe more of attractive for foreign buyers. So we can talk about the Switzerland, the Swiss franc, and the Zurich real estate, which we've covered in other episodes. But like right now, the Swiss franc is very strong, which is allowing investors in Switzerland. It's a stable economy in Switzerland, but real estate in Zurich is also super expensive because of the high value investors where they're going to park their money as like a safe asset, like you just talked about. There are markets where you can get in and get a great deal, but there's also these safe play markets that are made more for the long term, right? And when global markets are struggling, it can be an opportunity, especially for those holding USD. It talks about the Argentina and the Argentinian peso dropping, but I don't think that's overly relevant, to be truthful here.
Well, I think Argentina is an interesting one because they just had Milei go in with chainsaw capitalism. I mean, the whole motivation behind Doge in the U.S. is from Javier Milei, right? And so
That's right.
the reason, and this is where it is really interesting to look at, is the Argentine peso collapse in value. That triggered a massive political shift, right? Inflation like leads to revolution, and they went to into a silent revolution. I mean, they literally went from basically pseudo-totalitarian like socialism to pure capital, pure like literally libertarian capitalism or anarcho-capitalism as he calls it. And that's the fact that the people voted. Like, you can have a revolution in democracy, I think, without it being a violent revolution. I think the same thing is happening in Canada, in the US probably as well, most of the Western world, where basically inflation is happening. And inflation is destroying the middle class, right? It basically inflation inflates the assets of the upper class, and it deflates the buying power of the middle class and the lower class. And so it creates this massive disparity where you have fewer and fewer people holding more wealth and more people being poor. And what eventually that happens is the more and more people, especially in a democracy, the more and more people get pissed off and vote. And we just saw the same thing happen in the US, right? Where people voted for Trump because he said he was going to slash the government. And he's tired of all the fat cats taxing everybody into oblivion and spending all the money. Whether or not he does it remains to be proven, because I honestly am not super convinced that he's going to. But from my perspective, I would say Argentina is an important one here.
Well, there you go. See, I'm glad you knew all that about Argentina.
Yeah, and so, well, yeah, I'm obsessed with Milei, man. I've been following him pretty close. So you got to look this guy up. That'll be your toilet reading for later.
Is it on Twitter?
Oh yeah, you can find Milei on Twitter for sure. Yeah. I was thinking about him getting Milei tattooed with him holding the chainsaw over his head.
On.
Oh yeah, I do.
What's his Twitter handle? But
I don't even know. Yeah, what it is, but just Google him. Javier Milei. He's a beauty. Listen to his interview with his podcast with Lex Fridman. It's great.
He's got what a haircut.
Yeah. Oh yeah, the sideburns.
Yeah,
such a beauty.
Wow.
Yeah, he's iconic.
Incredible.
So.
Got distracted.
Yeah, we could use. No, it's okay. We could use maybe let's talk about Japan. We'll talk about Japan as well, because Japan's the carry trade, right? So tell me about Japan.
Have you been to Japan first and foremost?
No, I haven't, but I was literally just looking at Tokyo earlier. Like, I want to go so bad.
I would love to go to Japan. It's on the list. It's on the bucket list here. Japan, the yen, and the Tokyo real estate. So when the Japanese yen strengthens, U.S. investors hesitate to buy because Tokyo real estate becomes more expensive in USD terms. But when the yen weakens, the foreign investment surges, driving higher real estate demand. So look at this guy with.
I'll talk about the carry trade. Get
it going, man. The carry trade.
Yeah, so the Japanese carry trade is this really important thing, because like Japan for the last like 30 years had like the lowest interest rate in the world because their economy basically got smoked. Like the US basically did like economic warfare against them in like the 80s when they were worried that Japan was like going to become this global superpower, similar to the way that they're worried about it with China right now. And so basically investors borrow Japanese yen at very low interest rates, and then they convert to higher yielding currencies like USD or whatever. USD is yielding like your 7% is your interest rate in the US right now. And they'll invest in assets like real estate in the US as an example. So this is where you can get, again, we've talked about this a couple of times on the episode, but you can go and borrow money and in one country super cheap and then go deploy it in another country and get a higher return, and you make the spread, right? And so this creates this massive global liquidity, and it affects property markets worldwide. But when the yen strengthens unexpectedly, which has kind of happened recently, and they've actually had to start increasing the rates, investors have to quickly unwind those positions, and that causes market volatility. And so a lot of people think that the yen, whenever that yen trade flips, whenever the yen goes up in value and the interest rate starts to rise, it could really have a big impact on global currency markets. So that's one thing to watch as well. I also want to touch on Turkey, because Turkey's another good example. Turkey, known for exporting hair
I
transplants.
was gonna say that was my comment. You stole it right from me.
Was it? Yeah,
Yeah,
sorry,
yeah,
I
yeah.
had to. I saw your eyes light up, and you're
Yeah,
like,
yeah.
I got to make the hair transplant joke. Lots of dudes traveling to Turkey these days. Big tourism destination.
That's right. You see the airplanes coming
Lots
back
of
with
bald dudes
all the dudes
like
just with
Turkey.
bandages on their heads. No offense,
So
if you're getting a hair
yeah, whatever.
transplant
It
in
is what it
Turkey,
is.
have
Yeah,
that.
not my jam, but
It seems like it'd be a good trip, to be honest. On top of that, well, wait,
yeah.
hold on,
So
hold on. I want to go back to Japan because I'm gonna be honest. I'm learning here with you. Okay, what's the UN or UN? What's like the currency doing right now in Japan? Because I got in this argument with my fiance. Okay, she was trying to get me to go there for I think she wants like Japanese skincare. Okay,
right,
she
okay.
was trying to drop some facts on me about the yen and to the USD and to CAD. I think she's full of shit. So I need some
It's
lessons on this.
ripping against USD.
Wow.
Yeah, but
Right, but
relative
what?
to long term, like that's a 1 year, but it's ripping in the last month. Like it's up. I don't know what that would be. It's up
Oh, wow.
3% since. But if you go like historically, like you look back at like 2011, right?
Right,
You know, go back to it's like it's down pretty massively over time. The bigger piece is the interest rate, right? Because people won't borrow it without if the rates aren't low.
right.
So let's quickly. I'm gonna quickly chat on Turkey. So the Turkish lira's volatility 2024 lost like 50% of its value, right? Which made real estate in Istanbul extremely attractive to foreign buyers. So $500,000 USD property in early 2024 could have been purchased for around 250,000 USD by year end due to currency depreciation. However, in early 2025, so far this year, the lira has actually shown surprising strength against the CAD and the USD. It's actually outperforming CAD growth against the USD. It's one of the
Oh, wow.
top performing currencies against the USD, and a lot of that is because it's bouncing back off of like an extremely deflationary environment, inflationary environment. But kind of demonstrates how quickly these currency advantages can shift, right? Where
Right,
you could get a big growth relative to other currencies. And so one of the usually I'm not a timing the market kind of guy. And a lot of people will say time in the market rather than timing the market, right? I'm sure you've heard that one, Dave.
something like that.
But I think in a place like Turkey, just like hair transplants, they say you got to get them early, right?
That's
Before
right.
you lose too many of your hair follicles. Real estate can be about timing as well when you're thinking global markets, because currency markets are a lot more fast paced than property markets.
Right. I'm deep into the Twitter Turkey right now. That's pretty
Are
cool,
you?
actually. Yeah,
Did
I'm in.
you book your hair transplant or what?
I do. I got.
You
I
got
need
a full
a.
head of hair, actually.
Oh
You're
my
good.
god, I got too much hair. You guys need to. You can come to me for a hair transplant. I can give you some.
Done.
I got enough.
Done.
That's it. What's okay? You want to jump into? I know that you're gonna love this one. Cap rates. I've been hearing you talk about cap rates since I think when I was a
Yeah,
realtor.
it's another thing I'm getting tattooed on my body.
Yeah, absolutely. I remember when I was a newer realtor and I'd hear you talk about cap rates, and I was like, I guess I should learn this. So you're the reason I know cap rates, just so you know.
That's awesome. Actually, I take
Yeah,
pride in that.
the godfather of cap rates.
A cap rate is basically your net operating income divided by the purchase price of the property. The best way to think about this is like, it's kind of like a yield, but it's really about the property's operating performance, while your yield is kind of your actual financial impact. Yield calculations account for mortgage payments and leverage effects. So, a 5% cap rate property might actually have an 8% yield when, if it's leveraged with a mortgage and you're doing kind of a cash on cash. International markets do use different yield metrics, but cap rate is really like a property analysis. So it doesn't matter how you're measuring your yield. It matters what is the net operating income of the property. So all of the income that the property makes, deduct the expenses, that's your net operating income, and you divide that by the purchase price of the property. That is how you get your cap rate. And
So it's
the
less so
best thing,
focused on like the economics of that city.
well, you could use it to say, okay, on average, New York City multifamily cap rates are 4%, for example, as a Class A multifamily property in good locations. And the reason you would want to do that is because you want to maybe compare them against London cap rate institutional grade residential blocks for 3.5 to 4% cap rates, or Singapore for 2.7 to 3.5%. residential cap rates. Cities like Sydney, you're seeing like 4.25%, or Vancouver, you're seeing like 3.75% cap rates. So it's really useful as a comparison, right?
So
Yeah,
no, that's huge. Okay, so it's just another tool. Here we go. It's another tool in the toolbox,
it is.
right?
That's why we're saying that's what this episode's all about. The tools. We're giving people the 4 key tools, right? So, and it's the easiest way to really illustrate the value to you is take 2 properties, Dave. Give me two random properties that in Tulum right now, okay? And say one's gonna buy. Give me 2. Give me. Let's go property number 1. What's it listed for?
Okay.
250 USD.
No, let's go villas. Ready?
Okay, so yeah.
Okay, we got these are real. Villa, 3-bed, 3-bath, 519,900
Okay. And what would that make rent wise?
annually.
Yeah. Well, you could do it monthly. Yeah.
Okay, let
Whatever.
me do this. Let
I
me
can
pull
just
it up. Let me
calculate
let
it.
me get some real numbers for you because I don't want to
Sure.
embellish this. I'm going to use 2. This one's a bit unique because of the location. However, we can still use it. Okay, bear with me. Okay, let's go. It's going to be at like a 65% occupancy rate, or $100 a night. So what's that? It'll be like $400 a night. What's that monthly? Hold on, calculating.
So 95,000 a year.
Yeah, that's about right. Okay.
So
What else?
95,000 a year. And then what are your costs? Probably
Yeah,
30% of that.
about that. So you're gonna have HOA fees, which are about, let's say, 50 a month. So what's that? 3,000 a year. Okay. You got your maintenance. Let's say 1,500 for the year. Electricity about 2,000 for the year. That's not even important. Internet, let's say 500 for the year. Property tax about 1,300 for the year. So your total annual expenses you're carrying would be like 8,500, let's say.
So 86,000 per year, give or take.
Approximately.
Okay, so we take 86,000 and divide it by 519,000.
Yeah, 519,000.
And we get. I
Calculating.
did something wrong there. Give me a sec.
Should have just asked AI, man.
I know I should have.
I got
16.
yeah,
It's pretty insane.
I got
16 cap.
I got that's what I got too.
Yeah. Now I would say like a
Now,
16% cap rate is insane. Like that's like an
let me
incredibly
explain
good.
this one. Let me explain
Well,
this one. It's different.
I'll mention, because you mentioned it was an Airbnb as well.
Yes.
I consider Airbnb like it's a very lucrative investment, but it's also a job, right? Like there's some work to it.
Right.
You got to manage
We have
whatever.
to take away. I don't think we added in there a management fee. We got to take away a management fee, which would probably be 20% of
Right.
profits.
Okay, so then let's just drop that by.
Let's give them the facts.
Yeah. Explain to me why this one's different though.
This one's different because it's located on. This is a big plug. This guy should owe me. It's located. It's called Zamaya Fitness. Basically, this is like
That's that, eh?
like a world-class fitness facility with only 46 villas around it. They're going to have like big retreats there. It's like a very unique global brand. I think that will bring in significantly higher ROI than most other like average investments. But I have another one that I'm going to give you that's more realistic in a second that we'll use. That's cool, huh?
Yeah, it's sick. I remember you talked about this last time.
Mm-hmm. So you can see it's like, go ahead.
But even the net, like that's like a 13% cap rate net. Okay.
Mm-hmm.
And so the point of this whole thing is really just to show how, you can use this to compare properties side by side. So give me the other property, a more realistic property. So we'll say, okay, this one obviously is really a really high cap rate. And maybe it's because this is the very first unit that this guy's going to sell, and you're taking the risk in this project, right? Realistically, probably. And then you get a really good return, or you're taking the risk that maybe the occupancy rate isn't as high as you think, or whatever.
Yeah. Let's do a realistic one here. Okay. So let's go 439,000 purchase price. Okay. Now I'm going to give you the carrying costs. Cool. Or your operating expenses. Yeah. Well, same thing. It's going to be Airbnb, but I'm going to give it to you. I'm going to give you all the operating expenses. So the rent first would be, I'm going to say 300. How do we do this here? $300 a night at an occupancy rate of like 65%.
Okay. So 300 times 365 times 0.065.
Yeah.
Okay. So you're 71,000 a year.
Exactly. Okay. Now we need so we got a 25% management fee. Annually? You want annual?
Well, I'm just going to knock this down
Okay.
to 0.75.
Perfect.
So yeah.
Okay. Property tax. Ready?
Yeah.
Annual $750. Insurance annually $1,100. Your HOA fees $4,200. Electricity $2,400. Water's about $250.
Okay. That's it.
That's it.
So your net operating income, very crude net operating income, I did it in a calculator, not a spreadsheet, as you can see, would be 45,000, give or take. 44.
Give or take.
Let's say 44. We'll be pessimists here, not optimists.
I like that.
That's banker math, not realtor
I
math.
was gonna say, if you ask me, that's 50.
Round up to the nearest 75.
Hey man,
Okay,
crunch the numbers.
What's the price?
Dude.
I need the price.
What are you waiting for here?
I'm waiting here. Like,
Crunch
I got
the
the NOI.
numbers.
What's the price?
I didn't say 400.
Okay, sorry, 439,000. You probably did. So it's a 10 cap, just over 10. 10 points. So that's 10, and I would just multiply this by 100, by the way, to give you a number. So 10.1% cap rate. I guess actually the other catch on this would be you can't really, like, you guys don't use debt in Mexico. We've talked about this a couple of times on the show. So the big catch is your yield actually might be lower than buying a property. And we'll have to do another episode actually, like just breaking down yield. And I'll analyze a property like this where you're using no debt versus a property,
Right,
in Canada, somebody could buy, where they can use, 75% loan to value mortgage.
Oh, that'd be a good episode. This would be a good episode.
Great episode. Yeah.
We should compare
buying cash versus debt.
Yeah. You know what we should do is we should compare like multiple properties with real-time calculations across different major cities with and without leverage.
Yeah, no, that would make for an excellent episode. I agree with you.
Look at that.
You good idea, welcome. Dave. Hey. You're good at this. Big podcast guy.
It's the gaming setup I got back here.
Yeah. So I feel like we've sufficiently covered cap rate.
I think so.
I mean, basically a higher cap rate is typically a higher return, but potentially more risk. And the risk in these scenarios where we've looked at a couple of deals in Mexico that have insanely high cap rates from my perspective, maybe the project doesn't get completed. Maybe the market gets devalued or overbuilt because it's Airbnb. Maybe it gets saturated and hard to book. Maybe you don't see that 65% occupancy rate, whatever it is, right? Lower cap rate typically means lower return, but often more stability. So in the couple of cities that I mentioned, your New York City, Toronto.
Do you want to cover those one more
Sydney.
time? Maybe the average caps?
Yeah. So your average cap rate's New York City, 4%. Again, for comparison, we just brought you two deals that were over 10%, right? London, 3.5%, Singapore, 2.75%, Sydney, 4.25%, Vancouver, 3.75%. But I mean, these are not emerging markets. They're not Tulum. They're not cities that are just getting built up where you're kind of getting in on the early, you're getting a bit of a speculative boost in that investment, right? You're buying in established cities where you're competing with lots of buyers, and there's a lot of there's a lot of money chasing it, and so you have to pay a bit of a premium, and that means that your cap rate is lower. But really the point of the cap rate here is to compare properties side by side. So we just compared two properties side by side. We saw that one had a higher cap rate than the other. It's the easiest way to measure two properties side by side and how their price performs relative to their income that they produce.
Just a couple of guys giving you a couple tools for the old toolbox. Isn't that right?
Yeah.
Do you want to cover international financing?
Well, yeah, I think we should talk about probably, I think one of the key metric that you really want to think about is there even a lending market in the country that you're buying in? Is the lending market willing to lend money to foreigners? And how do we compare lending rates across countries? And we're going to have to do an entire episode on this, like you just said. But, like if I'm buying in the US, like, dude, every Canadian right now is trying to buy some property in the US, right? And I'm like, guys, your interest rates are literally 50% higher than here. Your dollar is 30% lower. Right? Like, explain to me what makes it such a compelling investment for, honestly, and show me a spreadsheet. Well, just show me a spreadsheet, two spreadsheets side by side, all the two, like Canada versus whatever deal you're trying to sell me in frickin' Ohio or whatever, right? It's like, if I'm going to buy some property in like some rural, like, town, or like some like small town in like snowy place near the Canadian border, I'll just do it in Canada. Right. Like,
For sure. I think like the like you said, the one thing to touch on is if financing is even an option for you. But from speaking to a lot of people looking to invest here, it sounds like a lot of these places, you're looking at like a minimum of at least 30% down. It's not like a traditional loan that would be used to in Canada or the US with like a low down payment. And that's actually what trips a lot of people up over here. I actually texted you about this today because I think it's the biggest hurdle for foreign or global investors is that we're so used to in North America leveraging debt. It's actually super common in these countries, even I'm only speaking for Mexico actually, but from what I've heard, it's fairly uncommon in these countries for anybody, even the local people that are born and raised here, to use some sort of financing. It's not that common. Most people here don't really utilize debt like we do in North America. It's just not the way they operate. They like, to be honest, when I bring it up to people in Mexico, a lot of them think that we're crazy for doing it. Like they can't, it doesn't make sense to them because they're raised on not leveraging debt, right?
Yeah, for sure. Yeah, so I think that that's like such an important factor to consider, right? Like if the country even has a credit market, if they don't, or sorry, if they do, what are the down payments? Like maybe even they do have they do have mortgages, they just got them. Mexico, they're like, all the Americans want to buy property here, we got to get the mortgages. They're willing to pay stupid interest rates, but the down payment expectation is what? They're like 30, 40. Yeah. So whereas in Canada, in the US, people are like used to buying their first time homes with, 5% down. Canada, same thing,
Right.
right? And now, and even if it's your investor, 20% down in the US and Canada, right? For DSCR loans. In the US, it's like, or in Mexico, it's minimum 30, probably closer to 50 for most of these deals. You get some countries where they have cultural oppositions to debt, right? Like, where it's against their religion to take debt on, right? So
Yeah.
this is one of the big things where you have to factor in, okay, yeah, maybe I'm getting a way better cap rate in a country like Mexico, but if I'm buying it at 50% levered, or, I'm not able to scale as quickly because I can't use debt, is my return really better?
Right.
And so that's one of the things that I think a lot of people don't think about. The last piece I want to touch on here is, I guess also in the rates, think about interest rate volatility and future rate changes. But the last metric I want to touch on here that I think is important, and I know we're getting tight on time, is vacancy rates across markets. Like, talk to me about Mexico. Is there like a seasonal ebb and flow in kind of like vacancy
For sure.
in market by market?
Yeah, for sure. I mean, like I can only it depends on the city, obviously, but I can speak for like this, like Quintana Roo, which is the state. Like actually, I'll speak more specifically for Tulum, but the vacancy rate, it's seasonal here. No, not many people are coming to Mexico to visit, so your Airbnb occupancy rates are going to drop drastically. You would make with an investment in Tulum, you would make the majority of your money, December, January, February, March, April, May, and then truthfully, you're not going to see many bookings. You'd see your occupancy rate go from, I don't know, 60 to 70% during those times, ranging, for whatever, but down to probably like a 10 to 15% occupancy rate come the summer months because it's just not too hot here, right? So your vacancy rates would probably be changing. And I think a lot of people here, like, if you're investing here, your tenants are probably going to be 6-month contract terms, right? If you're not doing Airbnb, if you get a 1-year tenant, you're laughing because you can kind of avoid that whole downtime. But most people here are signing 6-month contracts.
Yeah. So to really think about that, you need to analyze that exceptionally well when you're underwriting your investments, right? Like you need to include an allowance for vacancy because a lot of people, this is one of the biggest mistakes that I see people make is like they just assume that all of their suites are going to be leased out all the
Yeah,
time.
for
If you're
sure.
buying a multiplex, it's like, well, if the market vacancy rate's 7%, but it's like, oh, well, all my suites are leased. It's like, okay, cool. Well, if the market vacancy rate's 7%, statistically, it's saying that when you do have a vacancy come up, it's going to take you a month or two to lease that up, right? Like usually that's not uncommon. I own a lot of multiplexes in the Canadian market. And the truth is, when a suite comes up, it's typically not leased immediately. I'm usually burning at least a month, and we got to do some renovations or whatever to turn it over. And a lot of people don't even put that into their pro forma, right? They're just like, oh yeah, I'm going to collect rent every single month forever, right? That's not
For
how it
sure.
works. And so you really got to understand vacancy rate, the turnovers, landlord and tenant factors within that local market, and how that's
Right.
going to impact your ability. So these, from my perspective, are the key jumping off points for diving in and researching local markets. Google these things. Like just say, Mexico vacancy rate, right? You maybe
Right.
not going to get anything, but you might. And I think that really understanding those is key to formulating a good investment thesis and choosing a market that makes sense.
Yeah, I agree. I think what we do, we think we kind of uncovered a big grander purpose for this episode is I think we do like a live, or maybe not live, but a pro forma, and do a side by side for different properties in different cities, so that they can see how we should, or how they should run a proper pro forma to make a smart, sound investment. And again, that's why we made this podcast. Honestly, it's to help you make educated decisions, understand what you're getting yourself into. When you're getting into global investing, I think not really, I guess maybe two of these 4 points are maybe unique to what you're used to. Currency exchange for sure is something that you're not factoring into your current performance. So it's like, if we can help you with that, we all win.
Yeah, 100%. I think that's it, eh?
That's it, man.
Okay. Thanks for tuning in to Real Estate Without Borders. As always, make sure you hit the subscribe button and join us for our next episode. And share this with at least one of your friends. That's all we ask. I really appreciate it. See you soon.